Does your investment strategy actually work? Today, we're ranking 6 major investment theories from a practical perspective. You might be surprised, the very cornerstone of finance only ends up at number 6. By the end of this video, you'll have a clear roadmap for investing. Number 6, efficient market hypothesis. In one sentence, because the market is efficient, all available information is quickly and fully reflected in asset prices. So no one can systematically beat the market. The efficient market hypothesis is a cornerstone theory in finance, but from the perspective of real-world trading, it is practically useless. What it does provide, though, is a useful classification framework for investment theories. Why is it useless? Simply because it assumes people are rational, or that people's irrationalities in different directions can cancel each other out, making the market efficient. But in reality, people are far away from rational. Irrationalities often fail to cancel out. They may even reinforce each other, creating collective bubbles and crashes. So the market is also far from efficient. Specifically, the weak form says, historical information is already reflected in stock prices, making technical analysis strategies meaningless. But this assumption does not hold true. In practice, people absorb and process information over time, which leads to trend theory, wave theory, and cycle theory. Moreover, human nature itself has many flaws. This gave rise to Soros's theory of reflexivity and concepts like error tendencies. The semi-strong form says that all public information, financial reports, news, is already reflected in stock prices, making fundamental analysis meaningless. But this assumption is even further from reality. First, it overestimates human analytical capacity. In psychology, humans consistently overrate their judgment ability. Many financial professionals also lack deep industry knowledge. Second, only a few popular stocks attract thorough coverage. Most are under-researched. Third, the above discussion only concerns professionals. Most investors rely on second, third, or even fifth-hand information, further filtered through personal bias. This gave rise to fundamental investing, especially value investing. In the nutshell, the efficient market hypothesis is valuable as a theoretical framework, giving beginners a good overview of investment thought, but not much more. Number 5, technical analysis, trend theory, wave theory, and cycle theory. These theories are more practice-oriented, summarized in one sentence each. Trend theory. Stock prices move in a directional trend for a period of time. Wave theory. During a trend, prices fluctuate like waves. Cycle theory. Prices follow cyclical patterns. These theories came from practice, but lack rigorous proof. Finance classes sometimes even criticize them for not being scientific enough. Mathematically, they come from induction, not deduction. Are they useful? I can say clearly, yes. Why? Because markets are made of people, and both individuals and groups show patterns in behavior. These theories are rough summaries of those patterns. That's their essence. But they are far from rigorous. Though they look systematic and their proponents often exaggerate their validity, these theories are unreliable. They are like herbal remedies, sometimes effective in certain cases but with unclear mechanisms, and sometimes completely ineffective. Beginners often love technical analysis, since it seems to promise quick riches. I used to be the same, but now I see it as a detour, even something to avoid. Why? First, because it mixes truth and falsehood, making it easy to fall into blind faith. Second, trading goes against human nature. Jesse Livermore, often hailed as a pioneer of speculation, was worshipped by traders, and his reminiscences of a stock operator thrilled me. But he ended up almost bankrupt, and his fate was tragic. Technical analysis is like a tempting apple. Many won't resist trying it. My advice: learn the basics, but don't linger too long. Like herbal medicine, You just need to know that one plant might treat a snake bite, another might clot blood, another might repel insects. That's enough. Number 4. Behavioral finance, reflexivity theory, and error tendencies. Humans have inherent biases. A stock's price always deviates from its true value and corrections often overshoot, creating new distortions. Catching these deviations creates profit opportunities. This is Soros' reflexivity theory. Interestingly, it's almost the opposite of the efficient market hypothesis. This theory reflects real markets backed by psychology. First, self-fulfilling prophecy. People believe a result will happen, act accordingly, and end up making it happen. A teacher believes an ordinary student is a talent. The student receives very positive psychological cues, becomes confident, and works very hard. As a result, he truly becomes a very excellent student. Everyone believes a stock will rise and rushes to buy it. Consequently, the stock genuinely rises. Furthermore, the stock generates a profit-making effect. More people hear the company, pushing the price higher. At this point, the stock's rise is purely a sociological phenomenon, unrelated to the stock's intrinsic value. Of course, perhaps going further, the stock's fame leads more consumers to recognize the brand's quality or increases management's confidence, or provides greater financial resources to hire better people, causing the company to truly develop better, and the stock's intrinsic value also increases. That's another story. Second, cognitive dissonance theory. When behavior conflicts with beliefs, people unconsciously adjust thoughts to rationalize actions. My boyfriend is lazy, not attractive, and treats me poorly. The subconscious suggests, I haven't left him despite all this. I must really love him. This leads to an absurd result. The worse he treats me, the more I convince myself I love him. I lost money on this stock. The subconscious suggests, everyone is saying this company is definitely doomed, yet I'm still firmly holding it. That must mean it has great hidden value, so I choose to buy more. Many people say, I don't think I've ever thought that way. Note that the thoughts I just mentioned are completed by the subconscious. You might not even be aware of them. Our brain often works against common sense. In fact, it has quite a few error tendencies. This often leads to manipulation. Sometimes, it's not others intentionally manipulating you, but you spontaneously completing this manipulation on yourself. These theories have many other names. Robert Cialdini's influence, commitment and consistency, Charlie Munger's Poor Charlie's Almanac, inconsistency, avoidance tendency. Although Charlie Munger is a value investing master, he summarized more than 20 types of error tendencies that mislead people in investing. This belongs to the realm of behavioral finance, showing that the investment theories of the great minds are often interconnected. Error tendencies are the source of many absurd mispricings in the market. If you gain insight into the market's irrationality, your investment will mature. By the way, technical analysis is simply a visible surface manifestation of these psychological forces. If technical analysis is the periodic table, behavioral finance is the atomic theory. Behavioral finance explains half of how markets work, and I find it the most fascinating theory, but I still ranked it only number 4. Here's an open question. Many criticize Soros for shorting the Thai baht in Asian financial crisis, or the pound in UK turmoil, saying he caused the crises. Soros claims he merely exploited existing bubbles and policy flaws, accelerating inevitable collapses. He insists he was just a trader seizing opportunities in imperfect markets. What do you think? That's all for today's class. Next time I'll cover 3 more practical theories. If you find this video helpful, please subscribe and like.